Many of you found my channel through my CVS videos. A lot of you remember this stock. It used to be a very high conviction idea. A lot of you loved the company CVS. Maybe you still own it. Some of you told me in the comments you bought it and you sold it. You made some profits. I mean, that's good for you. But then I made a video 2 months ago, pretty much being a little bit more bearish on CVS and basically changing my mind, which I am not afraid to change my mind if the facts change. And the bad news was mainly CVS pretty much getting rid of their 2025 EPS guidance. They had $9 per EPS for 2024, around $10 plus for 2025. And I was looking at the $10 by 2025, and I was looking at the mean PE ratio for CVS, which is 12.5 times. I'm like, if CVS gets back to the mean once they pay off some of the debt, this is 10 EPS times 12 times. This is $120 per share. What I made the video was around $67 or $68 per share plus a dividend. This is something like 100% on the upside over the next 2 to 3 years, or even a little bit less than that. It was a pretty amazing upside, but the management got rid of it, and they were not confident in their numbers. So I changed my mind on CVS, and so far nothing has changed. It actually got a little bit worse. In terms of the latest reports, the management is still not too confident even about their 2024 guidance. And I'm gonna do another review on CVS, do another valuation model, and just give you an update, review the earnings, and just give you my opinion in general on CVS, as it's a stock that I'm pretty familiar with, and a lot of you keep asking me about it. A lot of you still own it. But CVS is still trading around $70 per share. There seems to be a pretty strong support line around 65. I mean, the stock barely goes a little bit below 65 and it just automatically gets bought. It's pretty interesting. But in terms of their recent earnings report, it wasn't bad at all. EPS per share, they beat 221 versus 213. They also beat on revenue. It was pretty amazing. But the stock went down like 6% on this news, and then it recovered. It always gets bought around 65. I don't know what it is. Maybe some hedge fund has some algos programmed or something, but at 65, the stock just bounces. It's pretty crazy. But the main reason why the stock has gone down around 6% and the market wasn't happy originally with these numbers is because pretty much kept the 850 to 870 guidance. But this is what the CFO said. He said, "We believe it's prudent for investors to ground their expectations for the 2024 adjusted EPS at the low end of our previously communicated primary guidance range." Now, there's 2 reasons he could be doing that. Maybe he's trying to set low expectations so he can beat, and this is normally bullish for the stock. A lot of people do that, but I have not seen that with CVS management. I mean, I'm pretty aggravated with the management, to be honest. I mean, I don't know why is it so hard to set low expectations from the beginning. They should have just lowered guidance last quarter and then they can beat it. But now they expect the lower end of the range. So I'm not surprised if next quarter they even lower guidance again and the stock goes down after it went up like 10 or 15% and CVS stays around 70 to 75. I mean, I don't understand why the CFO and the CEO are doing that. If I was them, I would have just trashed guidance and that it will be easier to beat it. But they haven't been doing that, and that gave me a little bit of concern that they are not even confident in those numbers. First, they had $9 of EPS in 2024. Then they said they are confident that it could be around 870 to the higher end of the range. Now they are not even confident about that, and they're saying it's the lower end of the range. So I would not be surprised if they even lower guidance again over the next quarter, which would make it very hard to value CVS on any kind of EPS growth metric, which is why I'm going to use a different valuation model here in the video. But everything else has been improving dramatically for CVS. Like if you remember, they had some problems with the Medicare quality ratings. They pretty much dropped a lot last year, and it's been pretty bad within the Aetna division of CVS. But now the company expects to have 87% of members highly rated in 2024. I mean, they did do pretty well on the ratings so far. Later in 2023, it improved a lot, and it could translate into bonus payments that lift revenues in 2025. So this is good news for CVS. A lot of good things are happening with the stock, but the management is still not too confident about guidance. Now, a lot of people do not invest in CVS because of the debt, and they immediately look at the total liabilities. They see over $176 billion. They say CVS is a trash company, and they immediately avoid it without even looking at the maturities, without looking at the the free cash flow, without looking if they can even pay this debt or the interest rates, they immediately see high debt and they just avoid it at all. And I kind of understand if this is your process, but I like to go a little bit deeper into the numbers to see if it's actually manageable or not. Now, the company has around 59 or pretty close to $60 billion of long-term debt. This is a lot of debt. But they also have other kind of deferred income taxes, and it adds up around $20 billion. So in total, it's something like $78 to $80 billion of long-term debt, which is a lot of debt for a company like CVS. But if we look at the maturities, I mean, the company is not going bankrupt anytime soon. The maturities are pretty good. Most of them are fixed interest rates, 2.8%, 4%, 3.3%, 2.6, 5, 4.1, 3.8. So most of them are pretty much below a 5% interest rates, and most of them are spread out. I mean, very little payments, $400 million, $600 million, $1 billion from pretty much 2023 all the way down to 2053. So I'm not really concerned about short-term maturities with CVS or CVS going under or anything crazy. There is some strikes with unions and all kind of things happening. I don't really understand this area of the business for me to determine what could potentially happen. I think no one knows the outcome of those things. But in terms of a debt problem, CVS is not going bankrupt anytime soon. But now we're going to take a look at the free cash flow of CVS to determine if CVS can even manage over $75 billion or $78 billion of total long-term debt. They have around $13 billion of cash. But let's just look at the liabilities without the cash, around, let's say, $75 billion. Now, the company is a cash flow cow, cash flow generating machine. I mean, they generate a lot of free cash flow. It's a very profitable business. Now, the free cash flow is between, or cash from operations is between 12.5 to 13.5 billion, and I believe it's going to be on the upper end of the range. All right. Now, they do have between 12.5 to 13.5. In terms of capital expenditures, it's between 2.5 billion to 2.7 billion. Now, let's just take the lower end of the range. Let's say 12.5 billion of cash from operations. They have CapEx around 2.5 billion. This is around $10 billion of free cash flow. Now, CVS does pay a dividend. The dividend is pretty close to $3 billion. This would leave them with $7 billion of extra free cash flow after the dividend, after CapEx, for them to pay down the debt every single year. They can pretty much pay the whole debt in pretty much 10 years and be debt free. Now, the company does have a pretty decent interest expense, over 2.2. It's now actually around pretty close to $2.5 billion every single year of interest expense. This is what's upsetting a lot of shareholders. They would like to see CVS pay down the debt, and I would agree. I think CVS should start paying it down, and I believe they will, because they've been talking for years and years about being vertically integrated within the healthcare space and acquiring something like Oak Street Health, Primary Care, and Signify, which is more in-home patient care stuff. Now they have everything they need. So I don't know why they would do more acquisitions. I would assume that now CVS is going to focus on paying down the debt, but as they have over $7 billion every single year to pay down the debt after the dividend, so I'm not really concerned about the dividend cut, and I'm not concerned about the long-term debt as long as hopefully or finally they even start paying it down and start managing it. I think investors would appreciate it very, very much. Now, it's hard for me to do a valuation like I did on CVS before, because they had their EPS increasing to 10 by 2025. Now, they're not even confident about their 2024 numbers, which would tell me that most likely EPS will be either flat or would be a little bit declining, or would be just flat in terms of EPS or free cash flow. So it's hard for me to use something like a PE ratio or enterprise value to earnings, which now the market cap to earnings is something like 8 times earnings, and you should trade at 12.5 times. But we're not going to look at this metric. What I personally see with CVS is something closer to the free cash flow yield. Now, the free cash flow yield on CVS is something like 12.5%. And they pay like a 3.2, 3.3 dividend from the free cash flow. Now, for me personally, if I was saying EPS flat, I would expect something pretty close to the 12.5% free cash flow yield, but they do have some debt. So I would expect maybe something 8 to 10% every single year if EPS is pretty much flat. Now, if EPS is a little bit higher, I would expect maybe something like 12 to 14% every single year. But for me personally, my argument is still the same, is that the stock market has come down. There's so many different opportunities with less debt, with some kind of more growth for such business. Yes, CVS is cheap, but it's cheap for a reason. And this is because earnings are not growing pretty much, and the management is not even confident about meeting the upper end of their guidance by 2024. So this is why CVS is cheap. I still believe CVS is undervalued. I still believe CVS could deliver maybe 10, even 12.5% closer to the free cash flow yield every single year. But for me personally, relative to other opportunities in the market, I see much better opportunities with pretty close to 15% annual. I even talk about them on YouTube. Although I have my own investment group, you could join if you're interested. But I do a video every single month talking about 2 stocks to consider. A lot of these stocks have 2 to 3x potential over the next 5 years with much less uncertainty and much less debt. So this was my honest opinion on CVS. I still believe it's undervalued, but I think there's better opportunities in the market. But it has bad sentiment, so I would not be surprised if the stock rallies and recovers on just bad sentiment. So thank you again for watching. It was not financial advice. I really hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.